Hello and welcome to Fundamentals, a platform to understand your fund tenets. Here we bring to you the minds behind the funds you would have invested in. Today we would be discussing a mid-cap fund. As you would know by definition, a mid-cap fund is supposed to invest 65% of its asset in equity or equity-related instruments. Today the guest for the day is Mr. Pankaj Tibrewal. He manages Kotak Emerging Equity Fund. This fund is more than 15 years old with an AUM of 21,000 crore plus and a performance track record of 14% return since inception. Hi Pankaj, welcome to Fundamentals.
Hi Harsh, great to be on your show.
So Pankaj, to start with, we would want to understand what would be your investment approach, style and philosophy of investing with respect to Kotak Emerging Equity Fund.
So Harsh, as you mentioned in the introduction, it's a mid-cap fund, and the philosophy is growth at reasonable price. The way we approach is that in India, if you remove the top 100 companies out, the 101 to 250th company is recognized as mid-cap, and below 250th company is recognized as small cap. So virtually, leaving aside the top 100 companies, the entire market is your universe in terms of stock selection. But one should keep in mind that the probability of mid-cap becoming large caps is just 9% over the last 20 years. So we may get excited to know that, multibaggers is the word to be in, but the probability is something which is extremely low. And hence you need to, move in this sector very carefully. And have a right stock selection. Otherwise, you could land up with losses as well. So the way we approach in this fund is that what not to do is more important than what to do. And we invert the situation and ask ourselves, what are the things we will not do or where we won't invest so that there is a permanent loss of capital. And I think there it brings in the 4 or 5 parameters or filters which we look into. The first one, in our view, is that in India, management is the most important component. And if you can get the right selection of management, even a mediocre business can really be a wealth creator. And if the management is lousy and not trustworthy, a great business can also be a wealth destructor. So it's very important that we do our channel checks right. We speak to the local CAs of the company and the city they operate in to get a feel on where the promoter's lifestyle is. Personally, is he leveraged or not? And so on and so forth. And a lot of time goes in speaking to the ecosystem, like the ex-employees, the suppliers, the customers, and choose the management rightly. And I think it's very, very important. The second parameter is that the balance sheet and cash flow is more important than the P&L for us. And time and again, we have seen that top line is vanity, bottom line is sanity, but cash in bank is reality. That if you can get the cash flows and balance sheet right, finally P&L will come and the company will survive over a longer period of time. The third one is the business, which means that is it a small fish in a large pond or a large fish in a small pond, which means either there is a runway for growth for the business over longer periods of time, and will the business grow given the opportunities around it. That's the assessment of the business itself. The fourth thing which we look at is whether the business is able to generate return on capital and able to deploy that capital back into the business in an asset-light way and generate higher rate of return, which means that if you are not able to do that, you will destruct value. Let me give you an example. So if you invest in a business which generates 7-8% return on capital, but your WACC, which is weighted average cost of equity and capital, is about 12-13%, there is a difference of 5 to 6%. Over and above, if you try to grow at 15, 16 or 20%, you will destruct value because your internal accruals at 7% won't be able to fund it. What you will do, you will take debt or equity and over a period of time, make your balance sheet heavy. And that's a perfect recipe for disaster. So we are very careful on what the business on return on equity and return on capital the business can generate, and the ability of that business to redeploy the cash flows back into the business. So that's the fourth point. And the fifth point is the valuation. that you should be buying businesses at attractive price. Otherwise, what we have seen that if there's no loss of capital, there's a time loss of or opportunity loss out there, because the stocks can remain at the same price for a very long period of time. And history has shown us that buying companies, great companies also, at not so great prices has resulted in time correction. So valuation is again very important. But let me mention you that there our focus is first to focus on growth, because growth is the horse, valuation is the cart. If they can get the growth right, the valuation automatically can sustain even at a slightly higher level. So yes, valuations are important, but we don't forget that growth is equally important and should not be left in isolation. So these are the few things we look into from a stock selection perspective. As a house, we cover 435 stocks under our coverage on the research. And out of these 435 stocks, we try to see which are the 50, 60 gorillas which are there, which should be part of our portfolio at that point of time. And we believe that out of those 50, 60 gorillas, few will turn into King Kong. And that's our attempt is that can these small and mid cap become large caps and mega caps over a period of time?
Got it. And Pankaj, that was a very, very elaborate reply and a lot of key takeaways for us, starting from valuations to growth to the probability of converting a mid cap to a large cap. Now, these are all theoretical till the time we don't understand with respect to the underlying stocks in the fund. So could you give us one or two examples from the underlying stocks in your portfolio where you would have used this framework and it would have played out in favor?
Yeah, so rather than naming stocks because of regulations, let me give you a broader perspective on a couple of stocks which have been our portfolio from a long period of time. So there's a chemical company in our portfolio which has been a 50x in last 10 years, right? But when we identified from there also, it's become 15, 20x. And the idea was that the company was gaining market share, and that means a long runway of growth in terms of the chemical industry. We could see the China plus shift happening, where large agrochemicals, large pharma companies coming to this company and saying that why can't you develop this molecule or manufacture this molecule for us? And that business is growing day by day. And the third is the refrigerant gas business, where most of the other players were exiting and this player was actually increasing their market share and focused on cash flows and balance sheet, never diluted on the debt side. Actually, on the contrary, they used the cash flows to delever themselves over the last 5-6 years and focused on growth and creating capacities. And the result has been that market has given a big thumbs up and the stock has compounded at a much higher rate than the earnings compounding. And the P multiples got re-rated substantially. The other company which I can recall is one of the explosive companies. Now it's India's largest explosive company. It's the second largest explosive company in the world. We entered very early on in that company, and over a period of time, they gained market share in India globally, diversified themselves not only in India, but in different geographies, but remaining core to the focus of what they know is making explosives. The problem in India, in most of the mid and small cap companies is once you attain a size, there will be advisors surrounding you and telling this business is also looking good, this business is also looking good. And the focus get diversified over a period of time. And I think when you look into this company, they remain focused to the core, what they understand the best. And now they are making a defense foray for the last few years. And few of the orders they have already received, which is in public domain. And I think that's where the new growth engine they have developed and which could be a very large over a period of time. So these are the things which we look into, and these are the guys whom they have done well on corporate governance or CG issues and other things. So that's where our focus is that first management, then business. Look at business from a cash flow perspective, balance sheet rather than P&L, making sure that the business generates return on capital, which is much higher, and then grow their business rather than growth at any cost. So these are the few principles which has helped us identifying some of the 10x in last 10 years in our portfolio as well.
Great. And a few examples which you gave are also reminiscent of the fact that you have not been benchmark hugging your portfolio. You have been taking calls beyond benchmark also, and that's the reason I think you have got the performance which speaks for itself. Now, coming to deviating from benchmark, we'll try to understand a bit on what are the sectors you are underweight and overweight in your portfolio at this point of time. So if you could help our viewers understand and get a sense of that.
Yeah, so if you look at, I believe that India is entering into a very interesting phase after almost 10 to 12 years. And this phase is the phase of manufacturing. I think for the last decade or so, our economy has been running on consumption engine. But I'm very pleased to share with you that whatever research at least is flashing at my end is suggesting that India is entering into a very strong manufacturing phase, which has not happened for the last decade or so. We did a trip and along the engineering belt of India, and the kind of enthusiasm this time we are seeing among the promoters, the entrepreneurs, we have not seen for a very, very long time. And where is this enthusiasm coming from? Three parts. The first part is that if you look at the corporate India balance sheet, it's in the best of the shape India has ever been, right? 46 to 48% corporate debt to GDP, one of the least levered corporate sector in the country today. And now what they are doing is, once their capacity utilizations have started hitting 76, 77%, they are looking to redeploy the cash flows back into the business. Last 5 years, they were looking to deleverage themselves. So now the growth on the domestic side on the capex is coming, on the private side especially. The second is the Euro plus one, Harsh. I think that this will be a much, much bigger theme than we all think about or we can imagine. Think about it. The gas price 2 years back in Europe was $3 MMBTU. Today is $50 MMBTU. The pain which the government, which the corporates are taking there, and a large number of corporates we are speaking to, which are in auto ancillary, capital goods, light engineering, precision engineering, they all are saying that every European company is coming to us and saying that this is the order, where, when, how you can supply to us, please let us know. When they used to go earlier, they used to take 2 to 3 years for approval. So I think the tables have turned, and I think Euro plus one could be a bigger one. The third one is the PLI, the entire push on production linked incentive scheme, which the government has given to 13 sectors. And I think that will be a very, very big game changer. I'm already seeing work happening on electronics on the ground, and many other sectors would follow that. The fourth one is the defense piece. The government has mandated 70% of the defense procurement to happen from indigenous manufacturers. And that's leading to an entire different ecosystem being developed into the country. And I think when you tie up all these pieces along with the government capex, which is continuing for the last 6, 7 years, I think you see a very, very healthy manufacturing ecosystem being developed. And I think it's a mega theme, which I believe that manufacturing sector could be one of the bright spot in the country. And the way we are positioned in our portfolio is through manufacturing companies across sectors I spoke about, plus capital goods and industrials linked to production, which probably will help you ride that production increase cycle in the country. That's one very important theme. The second one is financials. If you look at, as I said, corporate India is in the best of the shape, and that's been reflecting in the banking sector profitability growth. In the last 7 years, Harsh, banking sector in India has done a provisioning of 17 lakh crores for the NPAs. And my sense is that you have over provided for. And now when the economic cycle is looking up, banks are writing back, and they no longer need to provide such high provisions. And that's why the earnings growth in the banking sector looks to be very, very strong. So we like private sector banks out there and a couple of PSU names. And I think financials are a great place to be in. That's the second one. The third one is, in my view, the entire pharma space. It's a dark horse for me for calendar year 2023, but I think stars are getting aligned there. After 2 years of underperformance of that sector, we are seeing early signs of revival there. Domestic business is doing extremely well, and we are seeing early signs of reversal of fortunes in the US business as well. So pharma is a dark horse to keep in mind for calendar year 23. And the sectors where we are underweight currently is IT. We believe that one leg of more downgrade cycle is due. If the demand will be slow because of macroeconomic situations in US and Europe, it will reflect on the demand momentum of IT companies in India as well, which is not factored into the analyst estimate as we speak today. So I think that's one sector where we are keeping a close eye, but currently we are underweight on the sector.
Great. So you mentioned manufacturing, financials, capital good, industrial. I think if these sectors do well, it takes care of a lot of other problems also, which is really encouraging. So Pankaj, we have understood the underlying stocks, we have understood the sectors. Now to understand you a bit, you manage both mid and small cap, and it's a very rare distinction. Now you in your commentary also mentioned these two, hand in hand with each other whenever you were mentioning mid cap. Now, is there a different skill set required to analyze these two segments? What is Pankaj 1 and Pankaj 2 when mid cap and small cap allocations are decided?
No, so it's the philosophy is the same. The way of portfolio construction is the same. The definition now is very clear that in mid cap you need to have 65% so-called defined as mid cap stock, whereas in small cap it has to be 65% defined as small cap, right, which is 250th company and below. So the allocations that way are very clearly defined. And if we find any good stock, if it's a mid cap, the first preference will give to the mid cap fund. If it's a small cap, so it will go to the small cap fund. There will be some overlap where small cap fund will have few mid cap stocks which are part of emerging, or emerging will have some small cap stocks which are part of Kotak small cap, but the overlap can't be more than 35-40% because by mandate you can't be more than that. So that's the place where we are. So Pankaj 1 and Pankaj 2 from a management perspective remains the same. The philosophy of protecting the downside, making sure that we focus on consistency in this space, focusing on we protect the downside in this space, focusing we make less and less mistake in this space is the core, to both the funds. And I think till the time we can keep doing that, I think the outcome will be good. And I have always said that stock picking in India is overrated, portfolio construction in India is underrated. And till the time we keep our head down, keep doing the groundwork, be humble enough, I think the outcome should be quite okay for the investors.
Great. So Pankaj, we have seen a lot of newcomers or new investors into the market in the last 2 to 3 years, especially after COVID. And most of these investors get lured by the returns and they end up missing another element, which is risk, which is extremely important. So to make it clearer to our investors, what would you recommend in terms of ideal time horizon, return expectation from emerging equity fund?
So talking about return expectation, it's a very difficult one, but the way I look at it is that India is entering into a golden decade of economic growth. Yes, there are challenges from the external front, which we need to be mindful of. There will be volatility, every year, every month. And we are seeing that right now, 2% up, 2% down, everyday markets are where it is. But only advice I would give is focus on asset allocation. Don't get too carried away by the past returns and ask yourself whether you are made for equities first. People during good times are always saying it's a longer term money, but one drawdown of 20-25%, kind of question them whether they are suited for equity. So first ask yourself whether you are made for equities as an asset class, your temperament, your emotions are suited for this asset class or not, because drawdowns are a part and parcel of this asset class and it will happen. And ask yourself how you behaved in March 2020. Ask yourself how did you behave in May, June of 2013. Ask yourself how did you behave in 2008-9. And that will give you a clear reflection of your personality. And if you think you know yourself well, and I always say KYS is more important than KYC. Know yourself is more important. And if you think that you know yourself well and you think that you are suited for equities, then go for a proper asset allocation between large, mid, dynamic, and small caps. because not in every cycle, everything will perform. There will be cycles for different market capitalization as well. So just make sure that you don't get carried away by past returns, and make sure that you have a horizon at least of 3 to 5 years. Friends, this time, please don't make the mistake of chasing returns for the short term. You probably can go wrong, and the probability is very, very 50-50 of going right or wrong in a very short period of time. But history has shown that 92% of the time, if you are invested for more than 5 years, the outcome is very positive. More than 7 or 8% time above return is made 92% of the time. So, focus on that probability game, and rather than chasing short term and be momentum based, will be the only advice which I would like to give to your clients. And please manage yourself more. You are the biggest enemy of yourself in this wealth creation, nobody else.
Got it. So know your scheme and know yourself. I think these two are very, very important. And thanks for adding one term to our vocabulary. So Pankaj, my next question is from the previous question which you answered and the first question which you answered. So you mentioned that it's all about probabilities. And you also mentioned that historically we have seen 9% of the mid-cap companies becoming large cap. Now, it all sounds very good and very rosy, but then there would have been times when mid-cap would have become small cap also. And you would have also had certain incidents or accidents in your portfolio over 10, 15 years that you have been managing this fund. So tell us a few calls which didn't go right, or the way you would have planned those calls to go, and how did you react to that?
Yeah, so, obviously investing is a probability game. And as Peter Lynch has said, that out of 10, if you get 6 or 7 calls right, the outcome will be good. Don't worry about it. And so it's clearly a part of our, as well. Not every call goes right. But I think we, in the last many years, have avoided permanent loss of capital. And let me tell you how. So our investing calls have gone wrong in many areas, and especially since I've been managing for the last 16 years, there have been various cases. But the focus on cash flow and valuation or balance sheet has given us early warning indicators. Let me give you a small example. So we were invested in a construction EPC company, and thought that the company was doing extremely well. But somehow we figured out that over the last couple of quarters, the cash flow generation has not been good. And that rang alarm bells to us. The analysts visited different sites where the construction of that company was going on. And we figured out the company is dealing salary payments to its employees, which was the second bell. And hush, we probably didn't even wait. And there was a buyer who wanted that block because the company was in hot demand. We sold off our entire holding. We were lucky enough to get an exit. And the stock from there lost 90% and became a penny stock. So the point I'm trying to say is that even if you get your thesis wrong or your investing call wrong, and you are able to identify quite early, don't be married to that idea. Because if balance sheet cash flows are saying something else, trust me, finally it will happen. Iteration is first reflected in balance sheet and cash flow, later on P&L. And I think those indicators helped us, correct our mistakes very early on. So yes, mistakes will happen, but to me, more than error of commission, Harsh, what I feel that I have made many errors of omission. And I think error of omission, if you ask me, is far higher than error of commission. Because in error of commission, you can lose 80-90%. It's a lot, but you can lose that. But in error of omission, that 100 rupees can go to 1,000, 2,000, 3,000. And that's a loss of 20x, 30x, 40x. And in many cases, I feel really bad that either we sold the stocks very early on, and from there also the stocks became 15-20x. Or even after evaluating, we didn't execute those ideas. which later on became multi-baggers. How to, kind of, factor those losses. I think those losses are bigger than the losses on the commission side, if you ask me. And those are the regrets which I have, that why did I miss that? Or why did I sold so early? So we learn from our mistakes. And that's one learning which I have come across is that, yes, valuations are important, but don't look it in isolation. Look it in relation to growth. And there where I say growth is the horse, valuation is the cart. Keep a close eye on growth. Valuation will automatically follow it.
Perfect. That is a very, I would say, very candid reply and a lot of insights from that. And now, Pankaj, the next question is that you have been managing this fund for more than a decade now. Thanks to the performance, even after missing a few of those calls which you were mentioning, you have had a track record of stellar performance. And thanks to that, you have seen the AUM grow from practically negligible AUM to 20,000 crore plus AUM now. Now, you have mentioned cash flow, you have mentioned growth repeatedly in this podcast. I would want to understand for the benefit of our investors, has your investment style changed beyond these two terms also in any way? Or you're focused more on the cash flow and the growth now than it was earlier? Or there are other changes also in your investment style now?
So I think investment philosophy and portfolio construction both remain the same when the fund was 100 crores and the fund is 20,000 crore plus today. So there's no change in philosophy, and I work on things which are my strength or my team's strength. If we don't understand anything, let it pass. Okay, and that philosophy and investing side has not changed, even when the fund was in double-digit AUM. What has changed is that when the fund grows in size, the way you approach a construction of the fund has to undergo a slight change. Let me explain you by that. Earlier, when the fund was small, you could have done a sector or a stock which you liked. You could have slightly timed it better, saying that, okay, I know 2-3 quarters are still not going to be good. Probably near to that, I will go and buy it because the size is small. I will get my quantity. But the size becomes larger. What you need to be focused upon is that if you are liking that sector on valuation, you're liking that sector, there's very little downside left now. You can't time it to the T because you won't be able to build position in that portfolio. And I think that has changed. That if I like anything, I don't wait for the last moment to give me that confirmation. I start building position. And that is where you need to be a little ahead of the curve in making sure that you execute your thought process, right? I think that's one change which has happened along with the size. But otherwise, managing risk, which has been a prime importance even when the fund was small, continues even today. Focus on portfolio construction continues even today. Portfolio on how to make sure that we don't permanently erode capital, focus remains today. Making sure we protect the downside rightly, focus remains today. I think nothing on that front has changed except few smaller ones where we kind of take early calls now in terms of portfolio construction of a sector.
Makes a lot of sense. And with this, Pankaj, we come to the end of our conversation. We have understood your way of managing the fund. We have understood the underlying of the fund. One thing which we would want to know about is the team which helps you or assists you in managing this fund, because we all know you as the fund manager, you are the face of this fund, but I'm sure there is a teamwork behind this. So if you could help our investors understand what kind of a team bench you have, which help you decide on the decision which you end up taking.
So yes, I think, though I'm managing the fund, but the real brain is the entire research team. And they are the real hard workers who have contributed to this fund. And we have 11 people research team headed by a head of research called Shivani. And they are sector specialists having a very rich experience. Some people are having a decade plus, some people are having 14-15 years of experience in the sectors they have been tracking in. And we are blessed that it's been a very, very stable team for last many, many years. So each of us knows our strengths and weaknesses that ways, and we complement each other. And I think the team has worked hard enough to churn out the ideas. And as I said before, we cover 434 stocks in total. And that's an in-depth research the analyst does. And each of them covers about 40 to 45 stocks. That's distributed among 11 of the analysts. Apart from that, we have two ESG analysts as well, because ESG is an important component in evaluation now globally as well. And two of the ESG analysts engage with the companies where their ESG scores are lower, how to improve them, and make sure that we ask right questions to the companies. So that's the entire team which helps us. And obviously on the execution side, we have the dealers. And on the fund management side, the team is led by Harsha. We have my colleagues Harish and a couple of other guys who are responsible for managing different other strategies for the fund.
With this, we come to the end of our conversation. And it's been really insightful for us to learn how your fund works, what is your underlying philosophy, and how you decide on what bets to take. We really wish that your fund also grows 10x and 100x like the way your underlying companies grow. Thanks for taking out time on a busy day and helping our investors understand the nuances of your fund. Thank you so much.
For your kind and generous words. Thank you so much.
Thanks a lot.
Thank you.